right, everybody, here's session 2.2. Last time we talked about tax-exempt entities under the federal tax code. This time we're going to focus our attention on just the 501c3 entities that are considered charitable. The goals for this class session are to explain how personal income taxes work and then how charitable deductions work in that context. I want you to be able to explain why charitable donations are not a normal good, which is a term from economics, and then articulate why the charitable tax deduction is an economically inferior policy. I want you to be able to explain the elements of the organizational tests and operational tests, and these are how you qualify to be a charity under federal tax law. And then I want you to know and be able to explain the differences between these four kinds of charities: private foundations, public charities, private operating foundations, and supporting organizations. So let's start our conversation by talking about charitable tax deductions and first talk about how the personal income tax works. You remember from last time we talked about how if you're a business, if you're taxed as a corporation, you have your revenue and then you take expenses and offset your revenue with the expenses. Whatever you have left over is considered profit and you're taxed on that. It's somewhat similar to that with personal income tax, but the differences are still pretty large because by default, all of your income is taxable. And then Congress and the federal government have created certain kinds of expenses called deductions that you can use to reduce your taxable income. And so you're only going to be taxed on any income that wasn't offset by a deductible expense, basically. And so deductible expenses are kind of analogous to business expenses, except that there are a lot fewer things you can deduct from your income for tax purposes than there are expenses for business to use when they file their taxes. So we don't have a lot of things we can use, relatively speaking, to reduce our taxable income the way that corporations can do it. And so personal income by default is taxable. Some kinds of expenses can be deducted, and donations to charity are included in those things that are considered deductible. And so let's talk about how deductions have an impact on the true cost of things. Because in any given year, on any given day, you can spend your money on stuff that's deductible from your taxes, or you can spend money on stuff that isn't. The majority of stuff we spend our money on is not deductible. So you buy a candy bar, for example. There's a true cost to the candy bar that's hidden to us, and the cost comes in the form of the dollar we spend on it. And let's say it's $1 all in, like sales tax and everything. So you're spending $1 total on the candy bar at the register. There's still 15 cents in tax that you're going to have to pay on that dollar of income you used for the candy bar if you're like in the 15% marginal tax bracket. And so the true cost of the candy bar is $1.15 because of how income taxes work. You don't see that at the register. At the register, you just see the price plus sales tax. But there's also a tax that comes later in the form of an income tax because you spent your dollar on a candy bar. Now, if that's confusing, we're going to review this in class, so come ready with your questions. Alternatively, you could spend your money on a donation, like you could give to a charity. And if you did that, the true cost of the donation is just $1 because you get to subtract that dollar from your taxable income, and there's no longer the extra percent that you have to pay in the form of income tax. And so the true cost of a donation is whatever you donated, whereas the true cost of other things we spend our money on is whatever it costs to buy it, plus the income tax that we're going to owe on the money we used to buy it. And so this is an important idea because it says that dollar for dollar, donations are cheaper than candy bars. And what that means, they're cheaper in the sense that donations come without an income tax, whereas candy bars come with an income tax. And so that brings us to this first point. Deductible expenses are cheaper to us than taxed ones because the money spent on those things doesn't also carry an income tax. And so what this should mean is people should want deductible expenses more than regular expenses. Like it's cheaper to make a donation than to buy a candy bar, dollar for dollar. And so you should hopefully want to make more donations as a result. At least that's the theory. But it's important because there are some complications to this. One of them is that the way income taxes work in the U.S. is when you file your taxes every year, you can do what's called itemizing your deductions, where you add up all the individual things you can deduct and then report that on your form. Or you can just ignore all the itemized deductions, the individual deductible expenses you had that year. You just ignore those entirely. And instead you take something called the standard deduction. If you use the standard deduction, it means that you can't itemize. And what that means is donations don't count for anything on your taxes. There's no tax benefit to donating if you take the standard deduction. And right now in the United States, about 90% of Americans take the standard deduction rather than itemizing. So 90% of Americans that donate to charity don't get any tax benefit for donating to charity. Another important thing to consider is that deductions, when they happen, both for charity and for other things, are limited in time, which means that you have to declare them in the tax year where you spent the money. And they're limited in size, which means usually they're limited as a percentage of your income, for example. And so you can't give 100% of your income to charity and then deduct 100% from your income for tax purposes. There's no unlimited, sorry, let me rephrase. You have a limit on how much you can deduct as a charitable donation from your total income. And so you're never going to be able to give it all to charity and then pay zero taxes. That just doesn't work that way. So knowing these things, we need to explore this question. Is our current tax policy efficient in encouraging donations? Meaning by having deductions available to people when they make donations to reduce their taxes, are these deductions a good policy? Like, do we get a good bang for our buck as far as like taxpayers go? And a way to think about this is how much money, how much tax revenue is the federal government giving up in order to incentivize people to give to charity? Well, let's start with this graph. So this chart shows you the donations in billions of dollars by itemizers and non-itemizers in 1997. So itemizers are the people who added up their individual donations and other deductions. And then non-itemizers are the people who took the standard deduction that year in 1997. And what you can see is at the lower income levels, and this is quintile, so it's poorest 20%, second poorest 20%, middle 20%, and then let's see, the 60 to 80% richest, and then the 80 to 100% richest is how this chart works. And so here you can see that at low income levels in 1997, most people who gave to charity were doing the standard deduction, which means they were given to charity without any tax benefit. And then as you work your way up, you can see that the amount given by each quintile without itemizing was about the same amount. But those who did itemize, so they could declare their donations, again, a tax break, goes up dramatically as you go up the income levels. And also notice that the richest 20% of Americans, what this chart means is that the richest 20% of Americans gave more to charity than the other 80%. Now that has to do with a pretty high concentration of wealth. The wealthy are exceedingly wealthy compared to the rest of us. And this chart shows that. So that was from 1997, which is a long time ago now. But if you fast forward to 2020, you're going to see a similar pattern. Now, the colors here show different things than what you saw in the previous chart, but they're pretty. But it's still relatively similar. And what you can see is the same sort of relationship. The richest quintile gives more to charity than the other 80% combined. You can see the amount that was given in the form of what are called non-deductible charitable contributions, which means they were giving generously in ways that they could not deduct from their taxes. This would be like giving to a neighbor because their kid's having cancer treatment. That sort of thing. And that's what makes this chart different than the previous one. But also notice on the far right here, the top 1%, they account for almost half of the top 20%. So you take the donations of the top 20%, about almost half of that comes from just the top 1%. And you can also see that just the top 1% of Americans give more to charity than the other 80% combined, as far as like deductible charitable contributions are concerned. So there's a really high concentration of wealth at the top income levels. Now, why am I showing you this? Here's a chart that shows changes in tax rates to those really, really high earning people. And what you can see is that way back in the 1960s, if you were in the top 0.01% of taxpayers, so these are like the equivalent of billionaires today, you had a 70% marginal tax rate, which meant if you earned an extra dollar, you paid 70 cents in taxes on that dollar. Work your way down to the 1%ers, and you can see that their tax rate was in the low 40%. Get to the top quintile, and it was in the low 20%, and the lowest income earners, their tax rate, effective tax rate, was around 17 or 18%. This is way back in the 1960s, early 60s, late 50s. Fast forward to 2004, and you can see that a couple Republican administrations Republican-controlled Congress created huge tax cuts for the wealthiest Americans. Now, what's counterintuitive here, remember we talked about how deductible donations are cheaper, is this basically made deductible donations less attractive because their relative cost actually went up here. And when tax rates go down, the benefit of giving to charity also goes down because you don't have as much of a break as you did before. So by 2004, the richest, the 0.01%ers are paying a marginal rate of less than 40%. The 1%ers are paying around 35%. It's 36, I think is what it was in 2004. And then you can see for the rest of Americans, their tax rates have stayed pretty much the same. So during this time period, we saw dramatic cuts in the tax rates for wealthiest Americans. Now, combining that with this previous chart, if the wealthiest Americans are giving the most to charity, and then we made huge cuts to their tax rates, we should see huge drops in charitable giving. Because if the wealthiest Americans don't have as much of a tax benefit to give to charity, they shouldn't be giving as much to charity. But what we can see is over that same time period of the tax rate changes that I showed you, Americans keep giving around 2% of GDP to charity. And changes in tax rates don't seem to change the amount that people give to charity. And that's true for the poorest people all the way up to the richest. And so tax rates don't seem to move charitable giving very much. Now, they can move charitable giving in the short term because if you know a change is coming, you might accelerate your giving to take advantage of a deal now, or you might pause your giving to take advantage of a deal that's coming later with tax rates. But when you spread it out over time, charitable giving seems to not change very much. And so that brings us to this idea of a normal good. A normal good in economics is one that if your income goes up, you buy more of it. If the price goes down, you buy more of it. The basic idea is that a normal good is something you buy more of if you're wealthier. You can be wealthier by adding income, or you can be relatively wealthier by reducing prices. And in either case, you're going to buy more of a normal good. And that's what and so let's analyze whether or not charitable giving is a normal good. Well, with normal goods, as income goes up, consumption goes up. You buy more of it if your income goes up, and that's mostly true for donations. There's actually kind of a funny U-shaped chart where it's the poorest people in America give a higher percentage of their income, and as you grow to like the middle section of wealth in America, people give slightly less. But then as their income goes up to the top 20%ers, the top 1%ers, then charitable giving goes way up. So it's generally true that as your income increases, it's mostly true that as your income increases, then consumption of donations goes up. People buy more donations. And that means it's what we would call income elastic. And elasticity is this idea that how does one thing change as another thing changes? And this is elasticity where, and what this means here is that giving to donations is income elastic, meaning that as income changes, donations change too. With normal goods, as the price goes down, consumption goes up, and this is mostly false for donations. And so it means that people don't respond to tax prices that relate to donations. And so it appears that as you change the price of donations, people don't actually give more or less. Now, it's confusing to talk about the price of donations, but it's what costs do you incur by giving, or what benefits do you get by giving is another way to think about pricing of donations. And it seems to be the case that people don't really respond to price changes around donations. Like, other than the dollar you give to charity, what other economic benefits are there? People don't pay much attention to that, it turns out. And let me give you some other examples of that. There was an Indiana University paper that put the price elasticity of charitable giving at negative 0.2. If it's anything less than 1, it's inelastic. And this was like negative 0.2, which is pretty inelastic. There's a lot of other research that puts that price elasticity number a little bit higher, closer to 0.7 or 0.6. In some cases, you can see it actually is higher than 1, but only in particular circumstances where donors have a hypersensitivity to price. But generally speaking, we don't pay attention to that when we give. And so it appears that charitable giving is price inelastic, which means when the true cost of giving, when you consider all the other economic consequences or benefits, when the true cost of giving is calculated, that true cost doesn't seem to change how much we want to give to charity. And let me give you one other example of this. There was my favorite economist, John List, did a study with some co-authors. Dean Carlin actually was the other economist, who's also a fantastic economist. I think he's at Yale, if I remember right. But the two of them did a study in 2007 where they had a charitable organization send out fundraising mailers, and some people got a mailer just saying, hey, make a gift. Another group got a mailer that said, hey, we'll match your donation 1-to-1. Another group was told, we'll match your donation 2-to-1. And the last group was told, we'll match your donation 3-to-1. Well, what's interesting here is that the research showed that the existence of a match made a difference, but the size of the match didn't, which is not rational. You should want to give more to charity if you're offered a 3-to-1 match on your donation. But a 3-to-1 match had the same effect as a 1-to-1 match, which shows that we don't really think clearly about the true cost or price of our donations. And so charitable donations are not a normal good. They don't behave like the other goods that we buy, where as you get more of it, as you get more income, you buy more of it, or as the price goes down, you buy more of it. The first part is true, where if your income goes up, you buy more donations. But the second part is not true, where if the price of donations goes down, you don't buy more donations. And I think this makes sense why. True costs of donations are hidden from us, so it's hard to consider that. We also tend to give more relative to what's in our bank account rather than the eventual tax benefits that come later. And so if we're not really being influenced by tax law, like we're not really being, tax benefits aren't really shaping our giving, then why are we giving tax breaks for giving to begin with? If you remember, you have all these really, really wealthy people giving to charity. What happens when we incentivize all of these people, including the wealthiest, with deductions to give to charity? Well, here's an unfortunate and strange effect of this. If you're like one of 90% of Americans and you give $10,000 to charity, you don't get any, there's no tax break for it. The federal government doesn't give you any money back. They're going to tax you the same rate, so you're still going to have to pay your taxes, and you gave $10,000 to charity. But if you're in the 15% tax bracket and you did itemize your donation, the true cost of your donation is $8,500 because you're getting a $1,500 tax break from the federal government. It's almost like the federal government is subsidizing your donation by $1,500 because you itemized and your tax rate was 15%. If you're a really wealthy American and you're in the 32% tax bracket and you give the same $10,000, the true cost of your donation is only $6,800, and the federal government is kicking in $3,200 in the form of a tax break, basically subsidizing your donation by that much. Now notice, in all three of these cases, it's the same $10,000. It's not a percentage of income, it's just $10,000 for each donor. And what we're doing is we're saying, hey, if you're an itemizer, we're going to subsidize your donation. If you're a wealthy itemizer, we're going to subsidize your donation even more. And even though it's the same $10,000 given, and that seems to not make a lot of sense. And so what ends up happening is, because of how tax rates work and the standard deduction, donations by the wealthy are subsidized more than donations by the poor. In fact, donations by the poor basically get zero subsidy. But it also is weird because other things are deductible, like mortgage interest. And so if you have a mortgage and you pay interest on it, which most people do, you can itemize that as a deduction. And that makes, so if you have mortgage interest, you're more likely to itemize. And so another weird effect of this is that we subsidize the donations of homeowners more than we do of renters. Because if you're renting, you don't get the tax break of a mortgage interest deduction. And so you're not less likely to itemize. So renters are getting less generous treatment for their charitable donations, which has nothing to do with whether or not they rent or own a house. And then if you live in a city with high taxes, you're more likely to itemize because of the state and local tax deduction, which is called a SALT deduction. And that's an acronym for state and local tax. And so if you live in a high-tax city, you're more likely to itemize, and that means donations of people in high-tax cities are subsidized more than those in low-tax cities, which is also weird. Why does it work that way? It shouldn't. One of the alternatives that's been proposed many times over the years is that we get rid of tax deductions, instead we give a tax credit. Now, I'll let you pause here to kind of look at this if you want to, and we'll talk about this a little bit in class. But the basic idea with the tax credit is you don't do deductions. Instead, you let people calculate their tax bill, and then you attach the benefit, and then you attach the break on their tax bill, not on their taxable income, but on the actual tax that's calculated. And the benefit of that is it creates a more equitable system, and also probably saves the federal government a lot of money without reducing charitable giving all that much. Right now, the federal government forgoes or gives up around $40 billion in order to allow people to deduct donations from charity, and we're probably overspending. That's an idea we're going to revisit a little bit later. Okay, so that's the economic stuff, and I realize we're already 20 minutes in, but we're going to keep going. This video is a little bit longer, but watch it double speed if you're short on time. All right, so now let's talk about C3 status. So if you want to be a charity, what does it take? Well, you have to pass two tests. You have to pass what's called an organizational test and an operational test. The organizational test is a test of like your governing documents. And then the operational test is a test of what you're doing every day, your actual operations. For the organizational test, we're going to look for properly executed, legally enforceable organizational documents. This may slightly ring a bell. And what we're talking about here are bylaws and articles of incorporation. We're going to look at your articles, we're going to look at your bylaws, and we're going to look for evidence of these things. We're going to look in there to see if there's a dissolution clause. Do you say in there that if you dissolve, you'll give all the remaining assets to a charity or to the government? So if your charity dissolves and doesn't operate anymore, what happens to the leftover money? You're going to have to give the money to another charity or to the government because you have this clause in your documents. You promise that you're not going to engage in interment, and we're going to talk in the session 2.3 about what that is. You promise that you're going to operate for a charitable purpose. You remember we talked about how articles of incorporation all have like a purpose statement. You need to add this into your articles that says, we're going to do whatever's lawful and also whatever complies with charitable tax requirements. And then you're also going to have a political activity clause in there, where in your documents you have a promise that you're not going to engage in substantial lobbying and you won't engage in any politics. Now, the reason the IRS requires these to qualify for tax-exempt status is because this allows the law to guarantee that they have legal force to make you act the way you said you would act as far as the law is concerned. Let's talk about the operational test. So this is a test of what you do every day as a charity, and as you do as a nonprofit to qualify as a charity, a 501c3. And there are three parts of the operational test I want us to talk about. First of all, you have to be operating for a charitable class. We talked about this idea when we talked about charitable trusts. You have to be benefiting an indefinite class of people, and the activity has to be charitable. Now, this is where a lot of charities, smaller ones especially, screw up, because what might happen, for example, is a donor comes to them and says, hey, my neighbor has a daughter who's going through cancer treatment. I want to help them out, but I want to get a tax break. So can I give you $5,000 and then have you give the $5,000 to my neighbor so I can get a tax deduction? If as a charity you say yes to that, you violate the charitable class requirement because you're taking a donation destined for a specific person rather than for a charitable class of people. Another test is what's called the commensurate test, and the tax code describes this as the idea that your expenditures have to be commensurate in scope with your resources. What this is really saying is that you can't be spending a whole bunch of your money on non-charitable stuff, but there's no mathematical test here. The IRS rarely uses this test, and so this is sort of like something to hang over the head of charities that are being really abusive in spending their money on non-charitable things, but the IRS doesn't use this a lot in enforcement actions, and so just know that this exists. But if you're operating a charitable program, you're going to be fine. And then there's the business activity test, and this is how this works. As a charity, you might be selling things, I should say. You're always buying things, but you might be selling stuff. What you sell has to be furthering a charitable purpose, not because you take the profit and put that toward charity, but because the sale act itself is furthering a charitable purpose. An example of this would be selling textbooks to a student. I know that doesn't feel like charity, but if BYU sells you a textbook, they're enhancing your education, and that is charitable under the tax code. So that's what's called a related business income or related business activity. And so if it's related to your charitable purpose, you're fine. But let's say BYU opened a gas station and anybody could come up and buy gasoline from BYU. That's not a charitable purpose. And so all the income they got from selling gasoline would be an unrelated business income. And you're allowed to have some UBI, that's unrelated business income for short. But if you have too much, then you lose your tax exempt status. You also always, if you have UBI, you always have to pay taxes on that UBI on a tax form called the 990T, but don't stress about that being on a test. But the idea is that you pay taxes on UBI. If you have too much UBI, then you lose your tax exempt status. An interesting question here is how come Girl Scouts can make so much money selling Girl Scout cookies? Selling cookies is not charitable. So why does it count as UBI? And we'll talk about that in class. Okay, the other thing I want to talk about are the differences between 4 different kinds of C3 organizations. So within the category of charity under the federal tax code, there are 4 kinds of charities that we need to talk about. The first is private foundation category. If you're a charity, you might be a private foundation. In fact, this is the default status. So if you can't be any other kind of charity, you're going to be a private foundation as a charity. I want to note here that the term private foundation has legal definition. Sometimes the word foundation gets thrown around a lot to mean a lot of different things. Sometimes things that are called foundations aren't actually foundations. As far as the tax code is concerned, just know here we're talking about the legal definition. And when we say foundation, we need to include the term private for the legal term to be complete. So the accurate legal term is private foundation as 2 words together. Generally, private foundations are charities that are used by families and companies to give money away. So they basically are grant-making organizations. They take their money and they give it to other charities to do their work. And private foundation status is the worst of the 4 that we're going to be talking about. For example, you have to spend at least 5% of your assets every year on a charitable activity. And if you don't do that, then the government will tax away the difference. So if you spent 4% on your charitable activity of everything you own, you spent 4% that year, then the federal government's going to take away 1% in a penalty tax. I'm going to explain this table in a bit, but let me kind of highlight some interesting things about private foundations. We'll talk about the contribution thing at the end. As far as expenditures, we said you have to spend at least 5% of your assets every year, and it has to be well documented. You have to pay a 2% income tax on your investment income. So any of your investment returns or profits, you have to pay a 2% tax on. And then we're going to limit their behavior by both private benefit rules and self-dealing rules. And we're going to talk about those more in session 2.3. But just know these are strict, is what I want you to know about all these things that are in this table so far. So we're going to be very strict in the way we treat private foundations. Public charities are different, and the way you become a public charity is either you're what's called an inherent public activity. So if you're a church, school, university, hospital, or government entity, you can automatically get public charity status. Or you can prove that 1/3 of your support comes from the general public, your financial support. So take all your donations in a given year. If you can show that at least 1/3 of them came from the general public, and the IRS uses a mathematical test to calculate this, then you can be a public charity. For example, if you got all your money from 1 donor, you would fail this test. If you got all your money from 5 donors, except for, 5% from the general public, you would fail this test. So you have to get lots of donations from lots of people so that you can get at least 1/3 of your donation of your finances come from lots of people, and usually in the form of small donations, to qualify as a public charity. There is an alternative called the facts and circumstances test, where you can sort of make a case that, hey, we're close, and hey, look, what we're doing is public, and you might be able to convince the IRS, but that's a harder way to go. What changes on our little table here is that we're more generous in how contributions are treated for tax purposes. We're less restrictive on how you spend your money. It doesn't have to be 5% of everything you own, and you don't have to document it as closely. There are no excise taxes on your investment income, so you get all that investment income tax free. And you don't have self-dealing rules, which are very strict, and we'll talk about those more, like I said, in 2.3. So there are two other categories to talk about, and these are kind of blended categories. Let me go back. So private operating foundations are the ones that have a small group of donors, like private foundations do, but instead of giving their money away, they actually run a charitable activity. So they're operating, they're doing something like a public charity would do, but they don't have enough donors to be a public charity. And so you can get kind of a blended status between being a private foundation and a public charity. And they call that private operating foundation status. And so you're treated like a private foundation in some ways and like a public charity in other ways. And then a supporting organization is one that also can't pass that 1/3 public support test. And so the way they make up for it is they say, we promise we're going to support public charities and only public charities. And in fact, you usually have to identify the public charities that you're going to be supporting. And if you do that, if you have it as a stated mission of supporting a public charity, then all the benefits of being a public charity flow to you. And so that fills out our little table here. We're going to be generous with the way donations are treated. Private operating foundations have to spend at least 3% of their assets on the activity every year instead of 5%. Supporting organizations just have to prove that they're spending their money to support the public charity that they chose. Private operating foundations still have to pay investment income tax and still have self-dealing. Supporting organizations don't have to worry about that. Now, questions we'll discuss in class. Why have so many different categories of C3 exemption? Why have 4 different kinds of charities? And I didn't even tell you guys, there are 3 different kinds of supporting organizations, but we won't stress you with those. But we'll talk about why we have these different categories. We'll talk about whether or not the general public benefits from having these categories. And then we'll talk about why charity tax exemption is so complicated, like the ways we described. In class, I'm going to review this idea that if you give all your income to charity, you can't deduct it all from your taxes. I mentioned it at the start of the recording. And I will explain this table if we have time, but I'm not going to stress about it in the recording. I'm not going to test you on this, but it's just to talk about the maximum deductions that people are allowed to make when they give a lot of their income to charity. And we'll just kind of explore that a little bit together. All right, thank you for bearing with me in this extra long recording. It's going to be the longest one of the whole semester, so congrats on getting it done. We'll see you in class.